Good morning, everyone, and welcome to the 14th episode of the Capital League Insight series of webinars. The topic for today's discussion is economy and market outlook. Both the global and the Indian markets have seen severe volatility in the last few days on account of the escalation in the Russia-Ukraine crisis. And this was in addition to being jittery about rising inflation and anticipation of Fed rate hikes. Now, the situation in Ukraine is evolving, and one would need to monitor it closely as it unfolds. However, in the medium to long term, it is the fundamentals of our economy that will drive the markets. The Omicron wave seems to have ebbed, and the Indian economy is set to have recovered to the pre-pandemic levels. The Nomura Business Resumption Index is at an all-time high of 122, 100 being the pre-pandemic level. Growth data is on track with key gains in mobility data, followed by improvement in rail freight, and power consumption and unemployment rate also have remained steady. However, on the whole, the GDP or per capita income is much below its trendline growth had COVID not happened. So at a fundamental level in the economy, it is a tale of two halves. So post-pandemic, the situation and the recovery is vastly divergent. Between the organized and the unorganized sectors, listed versus the unlisted, tech leveraged versus the non-tech enabled, non-contact manufacturing and remote services versus the close contact services sector, and so on. So effectively, the recovery has been K-shaped and uneven, and sluggish services and consumer demand would be the biggest challenge going forward. Indian stock markets, on the other hand, have been one of the best performing in the world, especially in emerging markets, over the last 2 years, despite minuscule direct stimulus to the citizens during the pandemic. Going forward, there are several factors that are likely to affect the markets in the short term, be it geopolitics or Fed guidance, with near-term implications on oil and commodity prices, inflation and interest rates, and of course, valuations. So to understand the various issues impacting the economy and consequently the markets, we have with us today Nilesh Shah, an industry veteran and group president and MD of Kotak Mahindra Mutual Fund. I would think he needs no further introduction. Thank you for joining us today, Nilesh. Welcome.
Thank you, Rajul, for having me over here.
Our pleasure, absolutely. So before we start the discussion, I would like to mention that we shall have a 20-minute Q&A session towards the end. So please type your questions in the Q&A section at the bottom of your screens and address it to the panelists. So Nilesh, first of all, let me start by asking you to put in context the Russia-Ukraine situation, since that is top of mind for everyone. And what are the risks to the global and the Indian economy as the situation keeps unfolding and it's escalating now?
So Russia is one of the largest commodity producer, oil and gas, aluminium. Ukraine is fairly large producer of agriculture commodities. Now, as Russia and Ukraine go to war, all this supply chain can get disrupted. On top of it, Western world is imposing sanctions on Russia that also will disrupt this supply chain. Consequently, energy prices have risen across the globe, not only in oil and gas, but also in agriculture commodities. From an Indian point of view, we import 4 million barrels of oil a day. A $10 increase means I have to pay $40 million extra today and tomorrow. Now, fortunately for us, our food grain production is at all-time high level. Our granaries carry 3 times more than mandated requirement of stock. Between India and China, we'll probably have 60-70% of world food grain. So agri-commodity prices going up will have limited impact on Indian economy. If at all, there will be beneficial impact as we can export some part of our food grain and monetize it at higher prices.
Sure.
Our real challenges, oil and gas, will have to pay, for every $10 increase in oil prices, a $40 million a day bill. that $40 million is going to come from either our pocket or government's pocket or corporate India's pocket.
Right.
And this could have impact on inflation. We do expect RBI to revise inflation upwards from 4.5% in FY23 to maybe somewhere around 5.5%. This will have impact on rupee. Now at $630 billion reserve, impact will be minimum, but there will be some depreciation. And there will be impact on government's fiscal balance. Now, whether it's 50,000 crore, 1 lakh crore, one doesn't know right now, but there will be some adverse impact on fiscal deficit. So overall, we are concerned with the oil and gas prices, which impacts our economy. Fortunately, thanks to our IT exports and remittances, our ability to bear pain is there. Earlier, we used to get hurt at $40-60 a barrel. Today, $100 we can afford. But is it going to create pain? Yes, it is going to create pain.
So Nilesh, talking about oil, in the budget, government made a provision for oil at $75, I mean, for the year when they were planning their fiscal deficit, etc. And now oil is at nearly 100. So, I mean, that is a gap, but there is also, I think, one section of the market which feels that if Iran comes back to the market and if OPEC countries increase production, then oil probably would stay below 100 and would not inch up. So what is your take on that?
So one, the $100 oil is on the Brent side. The Indian basket of oil, because it is slightly inferior in terms of quality, is always little lower than the Brent.
Okay.
Second, there are two silver linings in the current scenario. Will oil prices remain elevated? Answer is undoubtedly yes, at least in the near term. But the first silver line you correctly mentioned is Iran. If US-Iran nuclear deal comes back on stream, which was negotiated by President Obama, then Iran oil can start flowing back into the market. The transportation cost of Iran oil to India will be the lowest. We are their next door neighbor, and that's why the transportation cost will be very, very low. The second silver lining is if India and Russia can enter into rupee trade settlement. Russia is a large producer of oil and gas. The transportation cost will be a little higher, but because we will be paying them in rupee, that should not bother us. So we will have to ensure that we take oil and gas from Russia in rupee terms so that we can get a suitable discount and we can, make this pain less in intensity.
So Nilesh, that was as far as impact on India. What about global economy? Do you think, I mean, Europe imports a lot of its oil and other commodity requirements from Russia and Ukraine. So would that, like you already mentioned, there were supply side constraints and this can, accentuate those. So would that further feed into inflation and be a cause of worry for the global markets?
So my feeling is that the suffering will probably move from entire Europe all the way to America. US will pay a higher price for the oil and energy. Now they can always increase their shale gas production and kind of compensate rising oil prices to some extent. But Europe will be very vulnerable. They depend upon Russia for their energy. They also depend upon Ukraine for their food grains. Now both will get disrupted and they'll have to pay higher prices. Unlike America, European economy is a bit more vulnerable. They have gone through a huge wave of COVID. Their fiscal deficit is already high. Their European Central Bank is already very, very accommodative. Interest rates are even lower than America. So my feeling is that the adverse impact in terms of higher inflation, higher fiscal deficit, higher debt to GDP, lower growth will be more felt in Europe then in America.
Okay.
US still has large economy to absorb this pain and
Mhm.
overcome, but Europe will get hit hard.
And right now, I mean, sanctions have been limited. So oil and gas, etc., has been out of it. So do you see that also, happening if the situation escalates? I mean, are they
So
keeping
you
it
look at
for
the
later?
stupidity of sanctions. Italian wants their Gucci bags to go to Russians. Germany doesn't want to stop imports of oil and gas. So the sanctions are more symbolic in nature.
Yeah.
And we have seen in the past, it does have some impact, but it does not have substantial impact. And more importantly, can Russia go to something like cryptos? They have already diversified their reserves from US dollar securities to gold and renminbi. If they start using cryptos, what will government do? It will become extremely difficult for Western world to impose sanctions on Russia, or whatever sanctions they have imposed to enforce that on Russia. So my feeling is that thanks to the emergence of cryptos, a lot of the sanctions may not be as effective as one is expecting.
Which is good news, I would think, from the market's perspective. And Putin probably knows that, so he's not deterred by these sanctions. He's following his own stubborn path.
The reality is that with this tension, oil prices have gone up and gold prices have gone up, and both are benefiting Russia, not hitting them.
Yes, yeah. As long as they can supply at a much higher price, it's good for them, and their reserves, like you're saying, are in gold. So that value has also gone up.
Absolutely. Will there be impact on Russian economy? Undoubtedly. They will get hit hard thanks to the sanctions. But their country is fairly large, fairly self-sufficient, and the sanctions will take a lot of time to have an impact on the economy. I think from an Indian point of view, we have to remember, that two monkeys and one cat story. The cat kept on taking roti from the monkey and ate it. We should play a fine balancing game between Western world and Russia and ensure that we get our benefits, we get our rights.
True. So, I mean, coming to Ukraine situation, how long do you think it will last, or it will come to its whatever logical conclusion that they install, pro-Russia government there, or do we have a sense of that? And could that also have an impact on the markets?
So a quick resolution undoubtedly will bring down energy prices and support growth as well as markets all over the world. However, it's very, very difficult to predict what will happen in a situation like this. From a Russia point of view, they just wanted Ukraine to not go into NATO. Western world has not accepted Ukraine into NATO. And I'm wondering, like, why did Ukraine invited wrath of Russia when they had no backing from NATO? It's something which is kind of avoidable thing from the Ukraine point of view. Obviously, they know what they have done, but from an outside perspective, when Ukrainian president made a comment that we are the only one fighting the war, well, then you should have made that observation before beginning of the war that you will be the only one fighting the war.
Yeah. So did you have any commitments of help or not?
Absolutely. The kind of destruction they are witnessing on their land and their size versus Russia, their non-nuclear ability versus Russia's nuclear ability. I mean, they can never win a war against Russia. So why did you invite their wrath? You should have simply avoided going into NATO. Or otherwise, you should have simply entered NATO and declared we are part of NATO. Then Russia would not have attacked them, because attack on one NATO country is attack on entire NATO.
Yeah.
And this is not one stupidity which Ukraine has committed. They have been committing this blunder time and again. In the 90s, under Budapest Agreement, they gave up their nuclear arsenal. They are paying the price for it today. In the past, they have supported Pakistan against India. Now they are falling at our feet to request Putin to stop. I mean, if you see the history of Ukraine, They have created one policy blunder after another.
Got it. So, okay, Nilesh, moving on, to the second major event, which has been impacting the markets for last 2-3 months and have kept them at edge, was the expected interest rate hike by the Fed and the rollback of the enormous stimulus package amounting to trillions of dollars. So how do you see that playing out? Because they have a rate hike is expected in March and we are just now at end of February.
So we are in a very, very tricky situation vis-a-vis Fed. As we speak, American inflation is at 40-year high. It is higher than India for last 6 months. And in all that 6 months period, Fed has kept on printing money and expanding balance sheet. They keep on saying that we will raise interest rates, but they haven't raised interest rates till today. Now, this has put huge adverse effect on their credibility. In Fed, they have two kinds of members, one who can vote for interest rate movement, one who can't vote for interest rate movement. The guys who are not voting members, they are very, very aggressive about raising interest rates. The guys who are voting, they are keeping mum. Now, Fed is almost being portrayed like a firefighter. When fire is there, they have rushed with their fire tanker. And first they are adding fuel to the fire so that it burns well. And they then say that we will throw water, we will throw water. Now, how do you respect this kind of firefighter? What will Fed do to regain their credibility? The answer is very simple. Please stop expanding balance sheet. Please withdraw your enormous monetary stimulus. Please raise interest rates. What they have to do is known to them. But why they are not doing what they are supposed to do is something which is a conundrum. Either they are not doing this because there is a midterm election in US. President Biden has a very, very low rating, and he doesn't want to take chance with economy so that whatever small chance he has of winning election disappears. President Biden had extended terms of Jeremy Powell. So obviously Fed governor is probably keeping that in mind. The second thing is that Fed probably knows about the vulnerability of economy more than the market. And that's why they are continuing printing of money and keeping interest rates low. In that scenario, markets will correct if what Fed believes becomes right. The third could be the impact of now high energy prices. These are all supply side issues. They are not demand side issue. And which is where Fed is saying that, look, for 2 years in COVID, we fought hard and created growth, maintained growth. Now, at the last end of COVID, at the endemic stage, I don't want to get away with 2 years of gain. So Fed's job has become fairly complex. What they should do, everyone knows. Why they are not doing those things, no one knows. Our feeling is that US equity market, US bond market have discounted around 3 to 4 rate hikes this year, including a 50 basis point rate hike potential in March. Now, thanks to Ukraine, it would have become 25 basis point. It's no longer certain 50 basis point. But as long as we see about a percentage point rate hike in US Fed, that is well discounted in markets, US as well as India.
In the current calendar year 22, you're saying? 1%.
Absolutely.
Okay. But recently, when RBI came out with its monetary policy, then it was more accommodative. So could you please elaborate, for the benefit of our audience, that why RBI is seeing things differently in India and not following the path which is chalked out by Fed?
So one, in US, fiscal stimulus was huge. In India, we didn't provide that kind of stimulus. Hence, US inflation is higher than India, and they should be more worried about inflation than us. Number two, our markets have taken RBI's positioning in a totally different manner compared to US. In US, Fed is talking about raising rates, and yet the 10-year government securities is below 2%. That is potentially the exit rate of US Fed in CY23. On the other hand, in India, the 10-year yield is 670. This is assuming about 100 to 125 basis point rate increase in RBI's policy rate. So in US, despite Fed saying market is not willing to discount, in India, despite RBI not saying market has already discounted. So RBI is also saying that, market is already ahead of our curve. Now, if I raise rates, maybe market will take it even further. So let me not raise rates because already market has discounted 100 basis point rate hike. That gives RBI some leeway to kind of delay the increase in rates, and which is where RBI is taking its chances with growth because market has discounted RBI's rate hike.
Okay, so in the budget, we had, highest ever market borrowing program, which the government may have to conduct in the coming year. So is that also likely to keep investors guessing on interest rates, that how will that pan out?
Undoubtedly, 11,18,000 crore net borrowing program was way beyond anyone's expectation. Yeah. It was almost 43% higher than previous year's borrowing program. A few years ago, 25,000 crore was the borrowing program for the month. Now it is one for a week. That's the transition of 4x growth in net borrowing program. Now, this kind of borrowing program cannot go through without impacting interest rates. It cannot go through without RBI's active support. And it will require enormous skill of RBI to navigate this, to make this borrowing program go through. In the past, they have achieved difficult tasks with a lot of easiness, and which is why we are now expecting them to do this miracle. Without RBI's active intervention, nudges, and support, borrowing program won't be possible to go through. My feeling is that RBI will, pull all its resources so that this borrowing program can go through. Now, market will be very, very carefully watching what is happening on the revenue side. The government came out with the revenue estimates, which are very, 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 very conservative. The RBI dividend this year is 1,01,000 crore. Next year, they are assuming 74,000 crore. Why are you dropping it with 27,000 crore when RBI balance sheet is expanding? Right. The small savings collection is down about 1,56,000 crore. Now, savings are growing, economy is growing. Why will small savings collection come down by so much? The divestment receipts for 2 years combined, current and next, is just 1,43,000 crore. Now, LIC IPO alone could raise you 1 lakh crore if you divest 10%. Yeah. Even the tax revenue receipts, the tax revenue for next year is likely to be achieved in this year only. The budgeted estimate of FY23 tax collection will be the actual tax collection in FY22. So are we assuming that there will be no growth in economy next year? In fact, if you look at IMF data, it's 9% GDP growth. Inflation of RBI is 4.5%, but the street believes it will be 5.5%. So 9 plus 5, 14.5% should be your nominal GDP growth. Budget is assuming 11.1%.
Yes,
now
let's assume conservative.
IMF and market both are wrong. But RBI itself is looking at the GDP growth of 7.8% plus 4.5. It is still not 11.1.
Yes.
So the equation which we were taught in the school, 7.8 plus 4.5 should be more than 11.1. We are not seeing in the budget. So market will be keenly watching RBI's intervention, the revenue trajectory growth, and seriously praying that despite a very large budgeted borrowing program, actual borrowing program will be less.
Unless, this Russia-Ukraine situation and oil prices go up and we can absorb that within that, and it does not impact the net fiscal deficit which is planned. Or I think
Absolutely.
they might have kept some margin if there is a fourth wave of COVID and, there are lockdowns, or they need to again provide for food grain or some kind of subsidy, etc.
So there is a lot of scope for spending undoubtedly, and every year we come with supplementary grants for the budget. But this time my feeling is that 6.4% fiscal deficit to GDP, it could come down substantially, well below 6%
Okay. Within FY23, you're saying?
within FY23.
Okay. So Nilesh, then talking about the budget 2022, it was growth oriented and high on continuity, stability, predictability. So what are some of the key announcements which you found were most significant?
So this budget, it can be described in one English proverb. If you give a fish to a man, you feed him for a day. If you teach him fishing, you feed him for a lifetime.
Yes,
This
I've
budget
exactly
is
been using that.
perfect. So this is the transition of fish to fishing. When pandemic hit, we gave subsidies of about 7 lakh crore through free food and other things. Now time has come to withdraw those things and create jobs and employment. The one weakness for our economy is the jobs, employment. Slowly and steadily, we are going above pre-pandemic level. But the income levels are probably still below pre-pandemic in many segments like school bus operator, education, tourism, travel, hotel employees, aviation, and so on and so forth. Now, this budget is saying that we will go and spend money on building infrastructure. We will create rules, regulations, policies. We will give you incentive for manufacturing. We will build infrastructure so that you can become competitive. Now go and conquer the world. Go and create growth. Go and create jobs, which will then sustain this development. This budget obviously has to give some fish because you can't take it away at one go, but it is making that transition so that we can make investments to create growth. And my feeling is that the budgeted numbers are very, very conservative on revenue side, reasonably practical on the expenditure side. And this budget has ticked all the right boxes from a growth point of view. Let's just hope and pray that the execution of the budget is as good as the preparation of the budget.
So what is your view on that? I mean, till date, they have had some kind of, similar aspirations in the past also. So what has been the track record on the ground in terms of execution till now?
So in certain aspects, execution has been fantastic. In certain aspects, execution has been very, very poor. For example, divestment execution has been very, very poor. Yes. For example, on building roads or building toilets or providing gas connection, the execution has been fantastic. In a country like India, we really can't expect top-notch execution, because being a democracy and with an active judiciary, there will be always unexpected roadblocks. My feeling is that by and large, we are getting our act together on execution at central level, state level, and local level. And if we keep maintaining this momentum, then I think we will see better growth. If I can give you an example about mobile phone industry and how things have changed. Sure. The mobile revolution happened in India in the 90s. And by 2014, we were the second largest consumer of mobile handsets. Obviously, we were at lower end of the mobile handsets. Our total production value was just about 19,000 crore in FY 2015, with 3 or 4 factories making mobile phones. We were more assemblers. We were importing $8 to $10 billion of mobile phones every year. There was fear that our electronic imports will exceed our oil import. Then government came and did lots of things. They gave 100% FDI. They chased potential manufacturers of mobile handsets to set up their factory in India. We created electronic clusters so that land and allotment of land happens easily, approvals comes easily.
Mm.
We gave them PLI scheme so that if you manufacture in India, we will give you cash. We put import duty protections. We created, we invited component makers to come to India. We also, you know, took several other steps in terms of single window environmental clearance and so on and so forth. Fast forward today, in FY21, our mobile production is up about 12 times from 2015 to 220,000 crore. From 12th largest manufacturer, we have become second largest. From $8 to $10 billion import, we are exporter of $5 billion. Apple and Samsung, the two large mobile manufacturer outside of China, they have achieved 100% of their PLI target. So they were supposed to make $2.5 billion worth of phone. They are expected to make $5 billion worth of phone.
Wow.
And more importantly, our value addition has started going as some of the components for mobile phones are also started getting manufactured in India. So glass panels, rubber and plastic component, PCB board, motor, they are all being made over here. It's almost like when Suzuki came to set up Maruti in India, auto component companies came and slowly we became big exporter in automobiles. Same thing is getting replicated in mobile phones. We have overtaken South Korea and Vietnam in terms of number of handsets manufactured. Value-wise, obviously, they are higher because they make high-end, top-end mobile phones. Now, the heart of the mobile phone is chip. And there are very few countries in the world which make chip. Now we have announced PLI scheme for semiconductor chips. It's going to be a very, very tough nut to crack because there is only one company in the world which makes machine. You need approvals from EU, US, Netherlands to buy machines. Operating those machines is not an easy thing. Mastering technology of chip is not an easy thing. So there will be huge challenges in executing that. But over next 3, 4, 5 years, if those chips also start getting manufactured in India, suddenly our value addition will jump from 15, 20% all the way up to 60, 70, 80%. Then we capture the entire value chain of mobile phone. We not only supply in India, but we also export outside. Now, this is how we have to replicate across various other industries.
So Nilesh, you talked about PLI scheme, which has been one of the major drivers for this. So are there other sectors which are similarly impacted, where other manufacturing sectors which will also create jobs, increase exports, etc.?
So PLI scheme is announced today for about 14 sectors. There is API and bulk drugs. There is special steels. There is technical fibers. There is auto and auto components. There are other sectors also. Now, each of this scheme has potential to make India a reasonably large manufacturing hub. They will give supply to domestic markets, so there will be import substitution, and they will be also becoming part of global supply chain management. My feeling is that the bus which we missed in manufacturing in 1980, to great extent, we will be able to capture in 2022 onwards. Will we become like China? Answer is undoubtedly no. They are at a much higher level. But will we close the gap with China? Answer is undoubtedly yes. What we did with Maruti Suzuki and Bajaj Auto and Hero in four-wheelers and two-wheelers, what we did with TCS and Infosys and Wipro and HCL Tech and Tech Mahindra in IT services, what we did with Sun and Lupin and Cipla and Dr. Reddy's in pharma, generic pharma, the same thing will get replicated in many other sectors, from API, bulk drugs to auto components to special steels to technical fibers to mobile handsets to room air conditioners and so on and so forth.
And specialty chemicals, I think that's another big one.
Yes.
Yeah. So, I mean, what about private sector investment? Is that also likely to follow? I mean, what is the government triggering at its end?
So the private sector investments will be K-shaped. There are certain segments where there is a lot of cash generation and hence companies are happy to go and invest. There are many sectors where capacity utilization is so low that there's no point in asking them to make investments. We believe there will be increase in private capital expenditure. It is already above pre-pandemic level, but it will be uneven recovery in capex. First, it will be led by technology, pharmaceuticals, renewable energy kind of sector. And then we will see real estate, construction, housing, cement coming into play. Then we will see automobiles kind of sector coming into play. So it's going to be a kind of cycle where few sectors take off, then the next few sectors join in, and then finally the laggards join in.
So, okay, coming to then corporate earnings, before the pandemic, we were already coming out from a down cycle. And the post-pandemic story so far has been good, especially in the listed space and the organized space. So how are the corporates faring in different sectors? And what are the challenges and opportunities for them going forward?
So corporate sector has benefited from a couple of things. One, when pandemic came, it hit small guys far more than the big guys. They have gained market share. Second, because there was pandemic pressure, they cut costs ruthlessly. Salaries were revised downwards, jobs were eliminated, processes were improved. Put both things together where they gained market share and their cost came down, it really improved their profitability. The profitability jumped up substantially. And we believe based on December quarterly results, we are on way to achieve about 740 to 750 rupee earning per share for March 22 quarter for Nifty
50 companies?
Nifty 50. And we should be somewhere around 850 to 875 for FY23 and roughly about 925 to maybe 950, 975 for FY24. So just rounding off 750, 875, 1000 looks like the trend for 22, 23 and 24. Now at today's level of 16,500, we are at our historical average of about 18.5 times FY23. It's a reasonable valuation, neither expensive nor cheap. It's fairly valued market. And corporates led by banks, technology, pharma should continue to show better profitability growth. Auto will be a slight laggard, but my feeling is that eventually even auto will pick up.
So what about technology? Government is also putting a lot of emphasis on digitization and including, technology in every part of whatever they are spending on. But globally, because valuations have come down for tech stocks, in India also the tech segment has suffered. So what is your outlook on the tech sector? Business
versus valuations are two different things. I think on business side, there is no worry at all on Indian technology companies. It will be fair to say, and it's little bit boasting, but it is still fair boasting that every program written in the world, there is an Indian programmer or a code writer. Recently I read, and this was like mind-blowing for me. In Kanpur, there is one kid who has now topped finding bugs in Google, and he's being paid in millions of dollars. Now imagine a giant like Google needs a support from a place like Kanpur. This shows that even in non-metro urban areas, we are seeing brilliance coming out. I was talking to one startup guy who says that I'm so fed up of people leaving me that now I have gone to the rural India and I find programming coding talent over there. I pay them like I'm paying in Mumbai. So they are happy doing work over there. And because they are working from very, very remote villages, no one knows that these people are there. So they don't run away from me. Now, the whole story here is that someone sitting in a village of India, semi-urban India, is able to get as much as you will get in Mumbai. This is the business potential of Indian technology company. One of the private equity investor was telling me that today, no startup in the world could think of getting started without support of Indian programming. We don't produce engineers like you people produce. Uh, Now, convert this into valuation. Our feeling, even somewhere around 6 months ago, 8 months ago, was that the mid-cap IT companies are running ahead of their fundamentals. And we booked profit in some of our mid-cap IT positions to go into large-cap IT. Businesses-wise, we were comfortable, but the market's expectations were running ahead of the fundamentals. Uh, we believe there will be a time price or a time correction or both in mid-cap IT companies. And after a while, they'll become worthwhile investing. So right now we are overweight large cap IT, but as mid caps IT correct, we will again rebuild our positions. Uh, Now, in the global context, things have changed dramatically. Most of our IT companies are profitable. They are onto programming side, they are onto maintenance side, they are onto infrastructure side. Very few listed IT companies are onto the startup side. Globally, what has happened is that many of the IT companies have moved on to startup side. They are trying to deliver solutions by burning capital. Now, in a rising interest rate environment, their valuations are likely to take a far bigger hit. So our feeling is that global IT companies and local IT companies' price trajectory will move differently. Their burning capital model is getting punished. In our case, because we have very few companies burning capital and most companies are generating cash, the impact will be far less.
Right. So what about the manufacturing sector? I mean, we talked about per se earning numbers, but in terms of top line growth, demand growth is still a challenge, and raw material prices could be under pressure if global commodity prices go up further. So how would that balance ultimately what we are projecting for earnings growth?
So as of today, we believe that companies will be restricted in pricing or passing the price rise. They will have to absorb something in their cost because consumer demand is weak. Now, can the consumer demand revive over a period of time? Answer is yes. We have seen employment numbers coming to pre-pandemic level. We believe income levels will probably reach to pre-pandemic levels in over next 3 to 6 months, hopefully without any new variant. If there is a variant, then this obviously goes for a toss. Keeping that in mind, we believe companies will cut cost further to absorb the price rise. And they will then do the price rise towards, let's say, second half of current year to get back to their margin. So we have assumed some moderation in FY23 profitability over FY22 because companies will have to absorb cost. Every company will not be in a position to pass the price hike to the consumers.
So Nilesh, since markets have now already corrected from peak levels, so your major indices like Sensex, Nifty are 10-12% down, mid and small caps are nearly 20% down. So do you think now the valuations are fairly valued or undervalued, or are they still an expensive category?
So they are fairly valued. We are around historical averages, give and take 5% here or there. We are not cheap like we were in March, April, May, June, July 20. We are not expensive like we were in Jan 2008. It's a fairly valued market. There will be some downward revision in earnings thanks to higher energy prices. There could be downward revision in earnings if another variant comes and strikes at us. But keeping those exigencies out, we believe we are at a fair value zone. This is time to be neutral allocation to equity or equal weight allocation to equity. If market corrects for whatever reason below 16,000 Nifty, then maybe one can start gradually increasing allocation to equity.
I mean, go above neutral weight,
but gradually and marginally.
I mean, a tactical call, but maintain.
Absolutely.
neutral
Absolutely.
or as far as strategically it goes. And what about the divergence between large and mid caps at current levels?
So this is one of these rare period where small and mid caps are now trading almost at the same or higher valuation of large cap. And this is primarily driven by mid cap IT companies, kind of companies where profit growth was expected to be far, far superior. Our view is that keeping in mind the uncertainty, it's better to be marginally overweight large cap and marginally underweight small and mid cap. It's not a high conviction call, but it is more of a cautious call, keeping in mind the current environment.
So would a 60 to 70% allocation in large caps be the ideal way to look at it at current levels? I mean, given all the risk which is there in the system.
For an conservative investor, 70 to 80% allocation to large cap will be better. For an average investor, 50 to 60% allocation to large cap is better. For an aggressive investor who is a long-term guy, probably 20 to 30% is appropriate.
Wow, only that much for an aggressive?
Yeah, because you are aggressive guy, so you can go, into small mid cap quite aggressively. In fact, I'll just expand this little bit.
Yes, yes.
So for a conservative guy, he could go towards a Kotak blue chip kind of pure large cap fund. Average investor could go towards Kotak flexi cap kind of large cap biased fund. Because of its size, it is large cap biased. And for an aggressive investor, they can go towards Kotak focused kind of concentrated large cap. Now, all three are in the large cap domain, but in blue chip, 80% is large cap, flexi cap, 75% is large cap, and focused about 65 or 70% is large cap. Blue chip and flexi cap are fairly diversified, whereas focused is fairly concentrated with just 30 stocks. So even within large cap, this kind of tinkering is possible.
Okay. Nilesh, also now several market participants, I mean, I think both in domestic markets and international markets are advocating investing in the value versus the growth part of the market, like old economy versus new economy. What are your views on that?
So personally, I have never believed in value versus growth. It's a marketing nomenclature, not an investment nomenclature. My job as a fund manager is to make money. And I have to take a call whether this quote unquote value stock is worth buying, because I have learned hard way that value without growth has no meaning, or value without unlocking has no meaning. I stay in Mumbai, and I used to work in Nariman Point, and every time you travel to Nariman Point for meetings, whenever I'm going from my office in suburb to Nariman Point, I don't look at the left side of window on Pedder Road. Why am I doing that? Because there is a huge MTNL building there. Pedder Road is the most expensive area in Mumbai, and value of that MTNL building always reminded me that this building's market value is more than the market cap of MTNL. So MTNL is a value stock. And I have paid price for that because MTNL mein kabhi value bahar hi nahi nikli. Similarly, growth, at any price is not perfect. We have seen how 100 PE stocks have crashed to 30 PE, even in the bluest of blue chip company. So growth without underlying value also has no meaning. So our job is very clear as a fund manager. We have to buy good companies run by good managers at reasonable prices. Now, there will be periods like March 20 where entire market will become value. And there will be periods like Jan 2008 where entire market, including value stocks, could become expensive.
Okay. Nilesh, what is your view on gold? Because, I mean, briefly, we talked about that because of this crisis, gold prices have gone up, but because of so much of stimulus, which was given across the world, and now if interest rates start going up, and ideally, the dollar should weaken, I mean, if the balance sheet has to contract. So do you think a medium-term case is there for gold?
Undoubtedly, we are bullish gold. We became bullish gold somewhere in pandemic time, March 20, April 20. Our call was that everyone will pump liquidity and keep interest rates low. That should benefit gold prices. In 2020, gold delivered fairly good return. 2021, we remained bullish gold, but it didn't deliver any return. In fact, it gave a negative return marginally. We maintained our bullish stance on gold on three things. One, we believe central banks from Russia, China will continue to shift their reserves from US Treasury to gold. Russia has already achieved it, and China also will be contemplating that. Second, the world will be awash with liquidity and low interest rates. That should support gold prices. And third, if we look at why in 2020 and 21, gold actually didn't do as much as it was supposed to do, partly because of flows moving towards other assets like NFTs and cryptos. Our feeling is that in 2022, there will be some flows coming back into the gold from the investor side. The gold ETFs globally have started receiving all-time high subscription. So this is kind of continuance of that trend where money might be moving from cryptos back into gold. Put all these things together, gold prices should remain supported. If you are taking a 3 to 5 year view, there is a good chance that gold will outperform fixed income. Now, when you're investing in gold, do remember few things. In India, we have about 7.5% plus surcharge import duty on gold. God forbid if that becomes zero, you will lose in one single day 10% of your gold value. So be mentally prepared for that, that whatever gold I'm buying today, 10% can disappear tomorrow if import duty is reduced to zero. Second thing will be, sovereign gold bonds are far better from a gold investment point of view than any other gold, including physical gold, because you get 2.25% to 2.5% return on sovereign gold bonds. It does carry lock-in of 5 to 7 years, but I think most people invest in gold for lifetime, never to trade. The third thing is that, many people, and especially women, they do Vichy with gold jewelers. I don't know whether Sapna and Rajul, you are doing it. Probably you won't be doing it, but there are so many women, including my mom kind of women, who will go and give fixed sum of money, 1,000 rupee, 5,000 rupee to the jeweler. And for 11 months you deposit, and 12 months you can go and buy a jewelry. Many women have been doing this, but they don't realize that many a times this roadside jeweler can disappear. Number two, when you buy ornaments, the transaction cost, the making charges are fairly large. Some people buy gold in smaller denomination, but that's at a very, very high transaction cost. If you buy gold in 1 gram, 2 gram, you end up paying 15, 20, 30% extra. So instead of this, why don't do same thing in gold ETF? It's not as remunerative as sovereign gold bond, but certainly it's not roadside jeweler who will disappear. And your transaction cost is 0.5%, 1%, 2%. So compared to physical gold, my preference will be gold ETF. Do remember that I manufacture and sell gold ETF, so I have self-interest, but I think it still makes sense to buy gold ETF compared to physical gold.
So with the medium to long-term view, it should be part of every portfolio, you could say, even from a diversification perspective.
Absolutely.
And you're saying it can give a return better than fixed income in the medium term.
Yes.
Where the returns are so low today. So Nilesh, let's look at a few questions. There is one on ESG investment, and we are hearing a lot about it these days because discussion on climate change has finally become more mainstream. So where do Indian companies stand on this matrix? And from an investor's point of view, does it make sense for them to channel their investments in ESG-oriented funds? Rather, I mean, there is very little choice right now, but just want
so we are at a crossroad over there. I think with rising energy prices, a lot of people are thinking, should we support ESG blindly? My feeling is that most of the non-ESG stocks have become very, very cheap. They are now trading above their historical valuations. So could there be a period where non-ESG stocks will do well? It is quite likely. However, if you take a longer term view, then companies which are more fairer to environmental, social, and governance standards, are they likely to survive? Answer is undoubtedly yes. Uh, Hundreds of steel companies have come and gone, but Tata still have survived because they have been following ESG since they were set up 100 years ago. Uh, so ESG is not a fad. It is not a fashionable thing. It is something which one will have to build into its corporate DNA. And we believe we have better ability to identify good governance companies, and certainly good governance companies reward shareholders over a period of time, and bad governance companies punish shareholders over a period of time. So this is uncompromised. We will always invest in good governance companies. The second thing is social side. Now, we are not as good in identifying socially good companies like good governance companies, but we are making an attempt. And my feeling is that we will figure out how to evaluate good, quote unquote, social companies. Again, uh, my gut is that companies which take care of society around that generally reward shareholders more than the companies which are not bothered about society. The third thing is environment. Now, this is where we are on a weak wicket. If I go to a company and talk about environment, he will put a PhD scientist in front of me. He will give me so many research reports and studies which will prove that what he's doing is right. I have no technical knowledge to counter them. We have to beef up our resources so that we can reach to that level where we can engage with companies. So what we have done, we have joined hands with Climate Action 100. It's a group of fund managers globally who engage with top 100 polluting companies in the world. About 5 of them are in India. Uh, Many of the large fund houses globally have recruited scientists and PhDs for this subject. When they engage with company, we become mute spectator. We listen to their discussion and try to absorb what is impacting environment, what is right way of correcting that. Now, over a period of time, we believe we will become reasonable expert in environmental and social as we have become on governance. And that will help us pick up good companies on a sustainable basis. They will create better wealth for shareholders. But there will be occasions, periods where non-ESG stocks will do well.
Okay. So Nilesh, the next question is on international funds. So obviously, I mean, we had also taken exposure to international funds for our clients, and from a long-term perspective, because of course these funds offer diversification and exposure to certain sectors which had no presence in India. And also, during the last 2 years, more attractive options were made available by domestic fund houses to participate. And during this time, though, the Indian markets have outperformed US, Europe, other emerging markets. And but right now, these funds are bleeding. So what would be your advice to the investors?
So, Sapna, Rajul, we ourselves launched a global innovation fund, which was fund of fund, investing into Wellington's innovation fund. And that fund is down 20% from top, 20% from issue price. Obviously, with the benefit of hindsight, it was a wrong decision to launch. Now, where did we go wrong? One, when we invested in this fund, it had a great track record. It had, for years, generated positive alpha of double digit. But immediately after our investment, within 1 week or so, China came heavily on their technology company. It wiped out more than $1 trillion of market cap in Chinese stocks. Now, there was no way to anticipate that China will do this. Obviously, Wellington had to cut their positions in China and booked losses. The second thing was a cycle where US interest rates were expected to rise, and that hurt companies which were generating losses or which were burning capital. Now, obviously, we had not anticipated that this kind of impact would come on the valuation side. And there also we lost money. Again, Wellington is taking corrective action. They are readjusting portfolio. Now, after 20% drop in NAV, what should one do? I got a call from a 75-year-old gentleman saying that, Nilesh bhai, I was sold this fund and it's down 20%. What should I do? I said, let me do some work and come back to you. Then I had a call with him and I said, your expectation is about 8 to 10% return. This fund is not suitable for you. You are better off in balance advantage fund kind of thing. This fund probably has been missold to you. Then he said that, who should be an investor in this fund? You tell me that. So I said, someone who wants high risk, high return. This fund is more suitable for them because it is investing into those innovative companies which are little above startups. This is also investing into large technology company, but it's a blend between established companies and startups. It is blend between technology and non-technology, between large caps and small caps. So the return profile will be high risk, high return. And if you are thinking of giving this fund to your next generation, then you can hold. But please be ready that there will be further drawdowns, further downside, there will be volatility. But if the fund managers call and one of the innovative companies also works out well, you will recover all your losses and will make money. Finally, he decided to remain invested. I just hope and pray that it works well for him. In a global funds, you will have to take a call in terms of diversification. We don't have enough information and knowledge about global companies. Whatever I talk about Wellington Innovation Fund is what I have read from them, what I have done Google searches, but I haven't gone and met any of those innovators or any of those companies. My knowledge will always be restricted. So my cardinal principle, please invest in global offshore fund, but not more than 10 to 15% of your portfolio.
Sure.
Please try to go into global funds rather than country fund.
So there is
US
a
and China,
flexibility.
US and China are like a continent, so fair enough, one can take a call over there. But otherwise, it should be global technology fund, global consumer fund, global oil and gas fund, rather than Saudi fund or Iceland fund or Zimbabwe fund. Number two, please don't put more than 2-3% in one fund. You need to create a cap on individual exposures. Third, try to invest with some dry powder. You never know what happens in global markets. Some corrections can come, and those correction needs to be averaged upon. For example, with Russia-Ukraine war, Russian market cap corrected 30% in a day. Today, they are 1/6 of India at $500 billion market cap. Now, you could not have anticipated Ukraine war and avoided investing in Russia. But if you are invested in Russia and this kind of corrections have come, you'll have to think about averaging at some point of time. So go with dry powder, put a cap on individual exposure, put a cap on total exposure in global funds. That will be the best way.
I think fortunately in India, we don't have options to invest in just a Russia fund or an Iceland fund and so on. Most funds were diversified over either developed markets or emerging markets. So at least to that extent, there is comfort. And for medium to long-term investors, hopefully it could provide to be a good diversification from a diversification perspective. So, okay, Nilesh, there's one more question on crypto, and you may want to answer that. There is a flux of investors in cryptocurrency in India in the last 2 years, and now the government and RBI are also talking about it. The recent budget has even taxed it, which makes it legal, kind of legal. In general, we have very little understanding, and investors, of course, have the fear of missing out. So what is your take on the same? And also, how do you think the digital currency being proposed by RBI will be different from the current digital payment platforms?
So, Rajul, the central bank digital currency is nothing but your rupee moving from your wallet into your phone. It is just a central bank's wallet. Now, how will it shape up is anybody's guess. Many people will say, why should I keep money in bank? I'll rather keep with central bank digital currency. In that scenario, even banking business will get impacted. Our feeling is that today, From a payment point of view, India is far advanced compared to rest of the world. When we use Google Pay, Bharat Pay, Phone Pay, Paytm, the transactions are instant, charges are virtually not there. Uh, Central bank digital currency will be one more variant of payment option. Uh, it was possible that this payment options would have started charging fees after making us addicted. Now with CBDC, that probability reduces significantly. But on the crypto, crypto assets is anybody's guess. On one side, there are critics like Warren Buffett and Russell Napier, which says that there's no underlying in crypto, and one day prices will come to zero. There are critics who are saying that crypto is nothing but hawala market, and people will use to launder money, people will use to subvert sanctions, and hence at some point of time, central banks and governments will come heavily on crypto. On the other side, there are proponents which says that the cryptos are independence from central banks tyranny, independence from paper money, independence from eroding purchasing power, and so on and so forth. Now, which way this will play out, no one knows. Today, people are buying crypto because they believe tomorrow price will be high, and some will be buyer there. If that trend reverses and everyone believes tomorrow crypto will be lower than today's price, all of us will be a seller of crypto. My recommendation to investors, think crypto as a high risk, high return gamble. It is a gamble, it is not an investment. And the money which you can afford to lose, that's something which you can pick up. If it works out, great. If it fails, no problem. In gambling, we don't go with the intention to win always. We just go there to enjoy.
Great. So Nilesh, we are coming to the end of our discussion. Would you like to sum up your message for the investors?
So one message, Rajul, is that please follow dharma of asset allocation. If you see 2020, 21 and 22, this 2.5 years, in Jan 20, did we have any idea that markets will correct to 7,500 Nifty? Answer is no. All we could say at that point of time that please maintain neutral equity allocation. In March 20, when correction came and hit us, we became overweight equity at 9,000 Nifty. Nifty bottomed at 7,500. We kept on saying that you become more overweight, more overweight, more overweight. Did we have any idea that index will touch 18,500 Nifty in October 21? If you had put a gun on my head and asked in March 20 at 7,500 Nifty, what will be my target? I probably would have imagined 12,000, 12,500. I could not have given a number of 18,500. From March 20 till October 20, up to 12,500 or 12,000 odd Nifty, we were overweight equity. Then we became underweight. Then we became equal weight. Now, market still went from 12,500 to 18,500, but we still remain equal weight. So the limited point is that there's no one who can predict the future, who can predict the market movements. All you can do is that based on today's prices and today's valuation, should I be underweight equity, overweight equity, or equal weight equity? Many people say that your emerging equity or small cap funds have delivered 20-25% compounded SIP return. But please remember that in March 20, same funds were giving negative return for 3 years. For 5 years, returns were lower than savings bank account. For 10 years, returns were comparable to bank fixed deposits. People took that pain. That's why they are seeing 20-25% compounded return for 10 years. People who didn't take that pain will not be able to see that return. So limited point, please follow the dharma of asset allocation. Markets will go up and down. It will go up and down beyond our expectations, beyond our understanding. And the only option available to you is that when markets are cheap, buy more. When markets are expensive, take profit. Neither you will make entry at the bottom, nor you will make exit at the top. But if you can invest around bottom and partially take profit at the top, that's more than sufficient.
So now that we are talking of a nominal GDP growth rate of more like 13 to 15% band for the next 2-3 years, can investors expect a similar return from the markets?
The returns will have to be moderated. In 2003 to 2008, markets gave a great return because we moved from a very, very cheap market to a bubble market. Now, in March 20, we were cheap. So from there to expect higher return was plausible. But now we are a fair value market. And to calculate my exit in a bubble is unwise thing. I can't assume that market will go to bubble, though historically it has gone into bubble once every few years. But if we assume fair value to fair value exit, then if you can generate somewhere around low double-digit return, that should be good enough. Beyond that, it will be difficult.
Great. Okay, thank you so much, Nilesh. Let's end the session. And I would like to thank everyone for joining us today on a Saturday morning. Have a good day. Bye-bye.